Welcome to the CFA Society India podcast, where society members engage in conversations with industry experts to bring you unique insights. This podcast represents the views and opinions of the originally featured speaker and is posted with their express consent. The podcast is meant for educational purposes only. It should not be construed as research, recommendation, solicitation, or investment advice by CFA Society India.
This episode is from the CFA Society India archives.
Now, let's dive into today's episode.
Welcome everyone to today's webinar. My name is Srinivas Kunte. I'm the Director for Professional Learning and Advocacy at CFA Institute. Our topic for this week is on mid-cap investing. Some think that mid-cap investing is actually an oxymoron. Yes, mid-cap stocks are slightly unloved compared to the richer, healthier cousins in the large cap category. But since you are attending this webinar, you are probably not among the faint-hearted, and you are probably among those who have seen an up-down movement of 50% and more. There are lots of myths on mid-cap investing, and today's webinar will hopefully uncover some of these myths. And we'll also look at some of the biggest principles that come to play in mid-cap investing. And for doing this, we have got one of the best minds in this space in India, Harshad Patwardhan. Harshad is the Chief Investment Officer at Edelweiss Asset Management. He's a veteran, of course, 27 years, nearly 3 decades, both on the buy side and the sell side. Harshad graduated from IIT Bombay, and he did his post-graduation at IIM Lucknow. Importantly, Harshad is a CFA charter holder, and he's been very generous and kind supporter of everything that CFA Society India and CFA Institute do. Harshad has a fascinating profile, lots of rich wisdom. He recently got an award in fund management. You'll know more about Harshad from his presentation. And without further ado, let's begin. How do you've been with mid-cap investing for 14 years. So how did you come to mid-cap investing? It's just serendipity, or it's something that you actively sought?
Sorry, I'm not sure I understood your question. Can you rephrase, please?
So is mid-cap investing, after moving from the sell side to the buy side, is mid-cap investing something that you actively sought, that you wanted to be a mid-cap person, or how do you go about being a mid-cap investor?
Okay, no, I do manage other mandates also. So we have multi-cap fund, but mid-cap, frankly, is mid-cap investing is fascinating because first 12 years of my career I spent on sell side, researching stocks myself, understanding sectors, etc. And as I explained with those charts, that mid-cap and small caps are basically parts of the continuum, which is less research. So personally speaking, the high you get by identifying a particular business early on, when not many people are looking at it, I think that is nothing beats that, right? So I would say that I enjoy mid-cap investing much more than large cap investing, although from a job perspective, I do both. And the other important thing is it also tests you better, because mid-cap investing, I did mention that during the course of but thanks for asking this question, because it's important to remember if you are investing in mid-caps yourself or in mid-cap funds, volatility and corrections is part of the game, right? You will generally notice that the volatility tends to be on the higher side in mid-caps and small caps, right? So that is the time that actually tests you. Should you buckle under pressure and take some action, or many times the corrections that happen in the mid cap, small caps, that allows you to buy stocks that you always wanted to buy at cheaper valuations. So I think that is a more exciting part of investing, in my opinion.
So Harshad, you touched upon portfolio construction a little bit when you mentioned at the design stage itself, you factor in liquidity. Can you spend just a minute on how do you get ideas? How do you get your ideas? How should people get their ideas on mid-cap investing? You've got many more portfolios under your belt, but the idea formation and portfolio construction, if you can explain in 1 minute. I'm sorry, it's a tall order, but if you can please.
Okay, so see, idea generation happens or you can get ideas from various sources, right? Firstly, one big thing that we keep doing or spend considerable time is attending investor conferences, listening to managements talking about their businesses and so on. So you can get ideas from there. You can also get ideas from sell side research, right? So ideas can come from, and of course, as a matter of your job, you are reading a lot. You are reading balance sheets, you are reading sector reports from that. So the ideas can come from anywhere. What is more important is to, 80-90% of the ideas you end up discarding. So in our research process, if you see, it's like a funnel. So there are many ideas that come from various sources, but post that, you have to basically think a lot about the business economics. You have to think a lot about how does this business make money. You have to look at the management track record. You have to look at the promoters. Are there any other companies that might adversely impact this particular business? And you have to look at the financials, and finally you have to look at the valuations. So it is like a funnel approach that if you look at statistically, we end up probably buying 5 to 10 stocks from the 100 stocks that we would look at. So a lot of what not to buy is also as important as what to buy. As far as portfolio construction is concerned, very briefly, as I mentioned, that primarily we get our ideas from a bottom-up perspective, right? So we do that, but there is also a layer where you have to think about sectors and factors and ask yourselves, am I taking inadvertent negative bets on any of the sectors or factors? And so that question is very, very important particularly if you are managing, a mandate, managing money for other people. If you are investing on your own, that factor may not be very relevant for you. But if you are building a portfolio for your investors, I think risk mitigation, looking at the negative bets also is very important.
Right. Sagar and this two of our attendees, Sagar and Isheng, they're asking about corporate governance. So how do you regard corporate governance? Is there a checklist that people can look at, for mid-cap and small-cap stocks?
Yes, so corporate governance, of course, is a very important aspect that goes into evaluating, business management and so on. So we spend a lot of time, and what helps is that, because now I've had almost 3 decades of experience, you remember promoters, what happened to them 20 years ago, 25 years ago. Many times the same promoters can come back in a different avatar, and you still remember what had happened last time round, right? So that helps. But yes, corporate governance is very important from the perspective of how they treat the minority shareholders. I will just give one example because it's a very vast subject and we can spend half an hour discussing that. I will just mention in 2018, recently when the market corrected, one other factor became very, very important, and we sort of consciously incorporated that in our investment process now, was the issue of promoter pledge. Because in 2018, what happened is when the market was correcting, businesses which had lots of promoter pledge, they were forced to sell. So therefore, when we look at the business and management, we separately look at the promoters, because this particular company from a promoter group may be doing very, very well, but there may be another company in the same promoter group which may be stressed, and promoter may need to fund, create funds for that company using this particular company. So that is just one example, but corporate governance is a very important issue, and that goes in one of the screeners that we have. The funnel that I mentioned, corporate governance is a very important issue. Yes.
One of the other questions, there's two folks asking this question. How do you spot the bottom of the cycle? Sandhya is also asking, is timing important in mid cap? And we know, as CFA charter holders, that timing is nothing in investing. But what are your thoughts in terms of cycles? Are there any such cycles, or is that another myth?
No. Frankly, Srinivas, my view in this particular aspect has evolved over a period of time after having looked at various cycles. So I will just give, explain with an example. Any stock that we buy for the portfolio, we classify into 4 buckets. Let me not talk about all 4. Let me talk about just 2. addressing this question. The first bucket we call strategic. These are typically businesses which are a typical compounding story, right? So if you look at private sector banks, let's say 10, 15, 20 years ago, that they have kept on generating 20, in the initial periods, 30%, then 25%, now 20% return year after year after year. Similarly, many consumer companies, paint companies have kept on compounding so these are strategic businesses, or loosely speaking, you can say that these are typically buy and hold kind of businesses, that if only if there is a strong reason to exit, you need to exit. But there are also businesses which are cyclical in nature, which are more levered to the economic growth. So I will give an example. I can't talk about stock, but I will give an example. If you look at construction related businesses, right? These are cyclical businesses. If you look at the return on equity of those businesses over the last 10, 15, 20 years, you will definitely conclude that these are cyclical businesses, that the bottom of the cycle, they may not be beating cost of equity, but in good times, they will do well. So cyclical. So the other bucket that we have are cyclical businesses. So we do buy some of them at the right stage of the cycle. The critical thing is you can never exactly buy anything at the bottom and sell anything exactly at the top. But broadly, from an economic cycle perspective or the sector cycle perspective, if you can buy some of these stocks at the bottom of the cycle trending up, you may not hold them for 10 years, but in 2, 3, 4 years, they can generate good returns for the portfolio. So we do that too.
Curious to know what are the two other buckets?
The other two buckets are, one is defensive, which is not from the perspective of consumer and pharma, which many people associate with defensive. Defensive from the perspective of the negative bets that I was talking about. So if you have a sector which has, let's say, 15% weight in the benchmark, right? But you are not very confident, you are not very positive. The question to ask is, am I so confident that I am prepared to own 0% when the benchmark is 15%? So sometimes you reluctantly, particularly if this is more relevant, Srinivas, for relative return mandates, where you are judged against the benchmark. So these are defensive bets that you reluctantly buy from a negative bets perspective. And the fourth one is options. As the name suggests, we don't buy options as in the futures and options, but options are the category where you may not have a long track record for that business, right? An example being, let's say, because it is in fashion these days, I will give an example. So if there was a business available to play electric vehicles in India, right? From a top-down perspective, that will be a very compelling opportunity. But clearly, there is no long track record. So these are the businesses that we sometimes buy in small quantity because the payoff from the option can be 0 or 1. Either you will end up making a lot of money or that will go to 0. So that's the fourth category.
It's fascinating because, Peter Lynch, I'm sure you would have known, he has got a similar categorization when he used to do his stock picking. There are many more questions. So I don't know if it is possible to spend only 30 seconds so that we can per question. So let me go quickly and highlight to me that it's not possible. Feel free to, take more time as well. Carl is asking, are the mid-cap index returns good due to survivorship bias? Any studies on or insights on churn in the mid-cap index? We know that there's a lot of churn in the Sensex, 50% over a decade. Is that right? So what's the equivalent number for mid-caps? Any quick thoughts?
So frankly, survivorship bias is definitely there, but that's there in all indices, large cap index as well as mid-cap index. So it is possible that it is, more there in mid-cap index, absolutely possible. But if you look at, and therefore, if you look at, don't forget about indices. If you look at a good quality large cap fund and a good quality mid-cap fund and compare last 15 years of track record, you will realize that mid-cap funds have done far better.
Right. What is, this is an anonymous person, but I also had this question, Harshad. So what is one of the biggest mistake that all of us can learn from, which you are able to share without taking any name of any particular company?
Sure. So frankly, I've made so many mistakes that I will need several pages to list them down. But let me talk about just one, which is very relevant in India, by the way. And I learned it, and this particular mistake I committed in 2015. When the current Prime Minister came in first in 2014, mid 2014, there was a lot of euphoria. And it appeared that he will come and magically change things across sectors and so on. I also fell victim to that particular mistake. So one big learning, one big mistake we made, and therefore one big learning for which I would like to share with everybody, is that the government announcements at the top level that they are going to do this, going to do that, may not immediately translate into a stock idea that you can buy. Because the timelines from government announcement, even though the intentions may be great by the government, for it to translate to a winning stock, it may take several quarters, if not several years. So, what I will, caution people against is that just because government announces, these days the markets are such that a government or even a secretary of government announcing something, though relevant stocks go up 10-15%, just like that. So I think we should guard against that euphoria, that for any government action to translate into a winning stock, it takes several quarters or even sometimes several years.
Yeah, I mean, most of the big investors, right, they've said that the holding period of any stock is forever. But as a CIO and also as a fund manager, you have got your compulsions in terms of retail holdings and regulatory rules. So how do you see that? What's your favorite holding period? What does it translate to in the mid-cap space? Is there a, to make it short, is there a heuristic people can use?
So as I mentioned, Srinivas, that we categorize stocks in buckets. In the strategic bucket, I would say that even my philosophy will be forever. So there are some stocks which we have bought in our portfolio 14 years ago, and they are still there. The bets would have changed. I think because we are active fund managers, it's very important to remember that there are times when I may need to change the bet, because I'm looking at it from the perspective of, and this is very different from an individual investor who may buy and forget, right? For him, things are different. Because we are active fund managers, there are times when we want to, it happens many times, just as an example, that we may buy a particular stock with an expected return of 30% over the next 12 months, based on our hypothesis of earnings projection, earnings progression, and valuation re-rating. In markets like these, the stock may be up 25% in a week, right? So we have to think from a portfolio perspective. So always we are thinking from an operating perspective on a 1 year forward basis. If that stock which we expected will go up 30% in a year is up 25% in a week or a fortnight, we do not hesitate taking some money off the table and invest it somewhere else where the stock would have fallen without any changes, because the expected return from there are higher. Now, this may be very peculiar to fund management. It may not be relevant for individual investors, but you have to do it. But for our strategic bucket, the philosophy is that they are there forever. We don't want to exit unless something bad. However, for cyclical businesses, you have to buy them at the right stage of the cycle and sell them at the right stage of the cycle. Just holding on to them because you want to hold them forever, that will actually not be good for your investors. So you have to look at the context as to why you have bought a particular stock and then decide. If you look at average holding period for our strategy, which by the way, which includes strategic, tactical, defensive, all. So on an average, we have held a stock at least for 3 years. But if you look at the strategic stocks, there are many stocks which we have never sold over the last 40 years.
So if you can spend just a minute or so on risk, right? The risk management tools that are being in use, like what are the practical tools you're using? Are you looking at portfolio parameters like price to earning ratios or betas? How do you manage risk? So what are the conceptual framework and what are the practical tools?
Okay. So, obviously when we do research itself, as I said, like a funnel, that is the time when we also obviously look at various risks, which is why, as I said, that typically of the 100 companies that, we would study, we will end up buying only 5 or 10 of them. Because when we are looking at the business, one of the most fundamental things in growth investing, I think, is the reinvestment opportunity, right? So that is very critical. But apart from that, when you are looking at managements, when you are looking at the management track record, when you are looking at the promoter group, there are many risks that you are looking at. You may not be able to quantify those risks, but obviously you are trying to eliminate many of these risks and therefore eliminate many of the ideas. From a risk perspective, I did mention that one of the very important risks from a relative return fund management perspective is how are you placed vis-a-vis the benchmark. And therefore, negative bets, I did highlight a couple of times that negative bets is something, it's an important risk mitigation perspective. And of course, you are looking at liquidity risk. I did spend the whole slide on liquidity risk is very, very important. And the way we look at liquidity is not static, right? In a year like 2018, beginning of 2018, before the market crashed, the number of average shares traded in a particular stock were very different from the number at the end of 2018 when the market collapsed. So you have to look at that particular risk in a very dynamic fashion. So what we do is we take average 3-month daily average. We assume a participation rate of 20%, 30%, and see how many days it will take us to exit that particular position. That's very dynamic. So liquidity risk, risk of negative bets, and of course, risk associated with the business management promoters are some of the risks that you have to be very mindful of. And you cannot really look at those risks before you buy the stock. You have to continue to monitor them all along.
So is drawdown a bit of a pain? I mean, Venkatachalam has asked this question. And there are drawdowns, and as retail investors, not just in India, everywhere in the world, people sell low and buy high. So what are your thoughts, very quick thoughts on that?
I think it's a very important question, and I'm glad that you took up this question. As I mentioned, in mid-cap investing, volatility and corrections is a part of the game. You cannot really run away from that at all. Volatility is bound to be there. And therefore, you're right that many investors actually behave in a very irrational fashion. What we do is that because our mandate, our strategy is open-ended strategy, we do not tend to take cash calls. So, you will not find us having 10% cash in the portfolio, because our philosophy is that the asset allocation is done by the investor along with his financial advisor. And then he gives us money to invest in mid-cap area. My job is to do that in the best possible way. So we never really take cash calls. We also do not deviate from the mandate and tend to own large cap stocks in the portfolio, because that's not why the investor has given me the money. My job is to invest in the best possible way in the quality businesses. If you recall, when I talked about the 3 myths, what we tend to do is we want to invest in leading companies in smaller product market segments. So when a correction in the market happens, it's inevitable that our NAV will also come down. However, because we have done our due diligence and we have underlying businesses which are of quality in terms of business management, typically there is no permanent diminution in value. I think in mid-cap and small-cap investing, what people should be very cautious of is the permanent diminution in value. In a market that we have witnessed over the last 18-20 months, when everything has gone up, all kind of stocks have gone up, small-cap and mid-caps. So what I would submit is that you cannot really run away from drawdown or volatility if you are investing in mid-cap and small caps. It is part of the game. But so long as you own quality businesses that you are confident of, typically the drawdown is temporary. Fundamentals do reassert themselves from a medium to long-term perspective. And this is exactly what we have seen over the last 14-15 years.
Jay is asking, what is the career advice? You must be getting a lot of resumes from people. Are you hiring, first of all? What is the career advice for many youngsters who want to enter as analysts, as fund managers?
Okay, so my advice, particularly to youngsters, is not to take a shortcut. If you really want to make a career in investing, it's very, very important. There are 2 aspects, broadly speaking, 2 sub-processes in investing. One is research, the other is portfolio management. So people who are young and just about starting, I would request them to spend as much time in research as possible. Focus on understanding the business, understanding sectors. So you can start with a relatively simple sector. which is, let's say, paint as a sector, which is relatively simple with only a handful of companies. Really try to understand the sector by looking at annual reports, and not just read latest annual report. If you have the time and inclination, read last 5, 10, 15 years of annual reports, so that the picture emerges and then you can connect the dots. So spend as much time as possible in reading stuff, particularly annual reports. These days it's not fashionable to read annual reports. There is so much of stuff to read. But if particularly for youngsters, I think reading annual reports, starting from the basics, fundamentals, is very, very important in my view. And that will basically help you understand the sectors, and then you will start making a mental picture as to how is paint sector, for example, is related to housing, how is paint sector related to automobile, and so on. So that's the hard way, but please don't fall for taking a shortcut, particularly if you are just starting.
You're from IIT Bombay, so are you using any machine learning, any of the latest technological advances that are there in data science and asset management in particular in your tool set?
Not at the moment, but that's an area which is very, very exciting, and I'm trying to learn on that. But at the moment, we are not using that.
One last question. There are actually two last questions, if you permit. Sure. You must be getting lots of resumes. What is the one thing that you want people to do in the resumes, and what is the one thing that you really dislike in the resumes?
I mean, that has to do with more, I would say, personality rather than is that I think somebody who's trying to show off, it tends to put me off. So, but that's I think the most important thing I would look for in a resume is, and resume is not enough in discussion, is the willingness to learn. I think the hunger for learning, particularly the youngsters, that is probably the most important thing. The focus should be on can I understand this better rather than can I make more money, because that will inevitably come if you understand stuff better. If you can form a mental picture of what's happening, you will be able to take good judgment calls and make money. So the focus should be, in my opinion, on learning. Hunger for learning is absolutely important, particularly in the beginning of the career.
So Harshad, now you've accomplished fund manager, CIO. What next? Do you plan to be the next Warren Buffett, the Peter Lynch? Are you going to planning to write a book? What are your thoughts?
Oh, no. I mean, you don't embarrass me by taking names of the greats in the industry. They are, of course, something that you look up to, but I don't think it's possible to match what they have created. One always strives. I am not really planning on a book, but what I do from time to time is that I do write articles on important issues which I think are critical for the distribution community and for the investors in general. So, for example, the liquidity issue that I talked about, the last slide, I did write a small 2-pager because nobody really has the time to read a lot of stuff. And we distributed it to our distribution partners and through them to our investors. Because there are many, as I said, there are many myths that we discussed in the beginning in mid-cap investing, even today. And there are many issues which are extremely relevant, like liquidity, which unfortunately becomes important only in bad times. But it's very important. It's our fiduciary responsibility to highlight that risk when times are good. So what I do is I do write on some of these concepts from time to time. But I will take that as a suggestion, and hopefully in the future think about a book also.
Where should people be looking for your write-ups? Is it on your LinkedIn page, or is it on?
I typically put it on LinkedIn. They're also available on, some of them are available even on Edelweiss website. Who
is your favorite investor, and what book should people read?
So I think there are things to learn from different investors. So I won't pick any single one. But I think from all the accomplished investors, there is always something that you can learn. It's very important ultimately to understand what kind of a person you are. What is your personality? What is your temperament? So not everything will suit you. But I think it is equally important, now that you have asked this question, to also know yourself. better as to what suits you, because there are different ways of generating returns in the market, right? We see people with very different personalities, very different styles, equally successful. So ultimately, the bottom line is you have to identify what kind of a person you are, what is your temperament, what suits you more, and just follow that path. If you try to do something which is very contrary to your personality and temperament, I don't think that will be helpful at all.
Any recommendations for books for people to read?
Nothing really. Frankly, all the investment books that everybody would have read. In my opinion, I think one should try to read not just investment books, but all sorts of books. So recently, I read a book written by our ex-Foreign Secretary Vijay Gokhale on Tiananmen Square incident, which was fascinating. He takes you back to those periods, which frankly we know only through the media. He was there on the ground. So I like reading books from across, not just investment books, because that actually expands your horizon. And again, as I said, helps you connect the dots.
Absolutely.
You can use that, the learnings from that, to try to understand what's happening in China today. For example, there are big things happening in China. This book helps you understand, gives you some perspective.
No, this has been a fascinating talk, Harshad. I'm sure our listeners would have enjoyed this a lot. It's going to be listened to once it goes on YouTube as well. I hope you liked it. Thank you so very much for spending time with us today and creating the presentation and coming and talking in front of us. Thank you very much.
Thanks, Srinivas. Thank you very much. Thanks again to CFA Institute India and everybody who attended the presentation. I really enjoyed the interaction. Thank you. Bye.
Thank you very much. Thank you all.
Thank you for listening in to today's podcast. Before you go, please subscribe to stay updated on your favorite podcast app.